heading towards the RBA meeting in February. What's your outlook for interest rates in 2025?
I think interest rates are going to come down this year. And while I wouldn't say the first meeting of the year is a lay-down misere for cutting interest rates, I think it's more likely than not that at the first meeting of the Reserve Bank on the 17th and 18th of February, we will see them cut the cash rate for the first time. And if that's right, if they do cut the cash rate for the first time, then history tells us that they will follow that up with another one at perhaps their April meeting. And there should be scope, in my view, for a third rate cut sometime in August. So that would see the cash rate coming down to 3 point something. That's still above most people's estimates of the so-called neutral rate. So monetary policy would still be on the restrictive side, but not as much as it has been since November 2023. Why do I say that? Because the most recent inflation data, I think, gives the Reserve Bank Board the confidence they've repeatedly said they need that inflation is sustainably headed back towards the target band in order to begin cutting rates. Now, when they talk about inflation in this context, they mean the underlying inflation rate, not the headline inflation rate, which has been 2 point something since the September quarter. But the measure that they look at, the trimmed mean, was only 3.2% over the year to the December quarter. That was 0.2 of a percentage point lower than they had anticipated. And while 0.2 might not sound very much, being on the wrong side of it by 0.2 of a percentage point in the second half of 2023 was enough to prompt them to make that last rate increase in November 2023. Moreover, the monthly inflation indicator, which admittedly isn't as comprehensive as the quarterly data, over the year to December was 2.7%. So it's in the target band. In addition, although some people might say the labour market's too tight for the Reserve Bank to be thinking about easing monetary policy yet. Although the unemployment rate is low, at 4% by historical standards, nonetheless wages growth has slowed from 4.3% to 3.5% over the first 3 quarters of last year. What that tells me, and what I think it will tell the Reserve Bank, is that perhaps their estimate of the unemployment rate that's consistent with sustainable full employment, as they call it, what some other people call the non-accelerating inflation rate of unemployment, is probably lower than their estimate of 4.5%. So taking those things on board and remembering that monetary policy works with a lag, the Reserve Bank has to make its decisions not on what inflation has done over the last 12 months, but what they think it will do over the next 6 to 18 months. Given that it does seem to be on a downward trajectory, if they were to delay any cuts in interest rates further, they would, I think, be running the risk of undershooting the inflation target, as they did for 5 years between 2016 and 2021, and of keeping unemployment higher than it needs to be to ensure that inflation is at their target, which they also did in the 5 years to 2021, with the unemployment stuck at between 5 and 5.5%. So I'd be pretty confident that interest rates will fall over the first half of the year. What I'm less sure about, to be honest, is how much scope there is for further reductions in interest rates in the second half of this year and going into 2026. Why do I say that? First, because the experience of other central banks around the world is that what they call the last mile of getting inflation down precisely to their targets has been difficult to achieve. And that's why, for example, the Federal Reserve, which cut rates quite aggressively at 3 meetings last year, has appeared to call a pause. The second thing is that I think it's likely that the combination of policies being instituted by the Trump administration, that is of higher tariffs, the extension of the tax cuts that were legislated in Trump's first term but are due to expire in June of this year, the extension of those tax cuts will add to the US budget deficit at a time when it's at full employment, so that'll be inflationary. And booting out between 1.3 and 8 million workers will also be inflationary. So the sum total of all those policies, I think, will add to inflation in the United States, add to inflation around the world, especially if other countries retaliate against US tariffs by imposing tariffs of their own, and that may limit the scope for further reductions in inflation and interest rates here in Australia too. And then finally, of course, after 2 consecutive budget surpluses, Australian fiscal policy is turning more expansionary. We're going to have budget deficits for the foreseeable future. And although the Reserve Bank won't comment publicly on fiscal policy as a factor in its thinking about monetary policy, I think the fact that we are now going into structural deficit will be something that, in the Reserve Bank's view, limits the scope for taking monetary policy into the stimulatory zone, that is with a cash rate of say less than 3.5%. So while I do feel confident that rates will come down in the first half of this year, I'm a bit more sceptical that we'll see many further rate reductions in the second half of this year or into the first half of 2026.
If the rates do come down in the first half of the year, what do you expect to be the flow-on consequences? Do you see a radical increase in consumer spending? Do you see businesses spending more, or do you think it will still be quite measured given that the rates have been high?
I think it will be fairly measured, but there will be a positive impact from reductions in interest rates. We know that around a quarter to a third of the Australian households have been severely impacted by the increase in mortgage rates. And households aged under 40, according to the data compiled by the Commonwealth Bank, have been cutting their spending in real terms. And households between 40 and 60 have been increasing their spending, but by less than the inflation rate. And it's really only households 65 and above who obviously aren't affected much by increases in mortgage rates and sometimes benefit from increases in mortgage rates. They're spending as if nothing has happened. So as mortgage rates come down, heavily indebted households, younger households, will be able to spend a little bit more, and that will boost consumer spending to some extent. We've already seen businesses being quite resilient to increases in interest rates. You know, some small businesses have obviously been struggling, but I think it's notable that through the last year, while interest rates have been quite high, lending to businesses has nonetheless picked up. And that's consistent with the idea that non-mining business investment is actually quite strong. You know, mining investment's slowing, as you would expect, but investment by firms in other parts of the economy, in manufacturing and services, has been quite resilient, and I think that reflects the fact that businesses know that they've got to invest in digitisation. They've got to invest in artificial intelligence where that's relevant to the way business is evolving. And there's a bit of a catch-up for many businesses from a decade of very weak investment between the global financial crisis and the onset of COVID. So I'm reasonably positive about the prospect for an increase in business investment. What I hope doesn't happen is that lower interest rates reignite upward pressure on housing prices. You know, part of the reason why housing has become yet more unaffordable over the last 3 years is because of the impact of the period of record low interest rates we had during COVID. We know that went on for too long. And I do worry that history tells us that big cuts in interest rates, if we were to get them, would fuel another boom in house prices, which would more than offset the potential benefits of lower interest rates for would-be housing buyers, and I hope that doesn't happen.
Let's talk about housing and your ideas about how to fix the housing crisis. What do you think is the best solution to fixing the housing